Welcome everyone to take two of this week's Facebook Live. Now, I was listening to the radio during the week, and I heard that Eddie McGuire's catching up on Who Wants to Be a Millionaire, and he recorded a couple of episodes while up in the hub up in the Gold Coast. And one of the recordings that they did during the week was lost, and he had to redo it. So I don't feel too bad for having recorded a whole Facebook Live without sound. So if you joined me previously and you watched 15 minutes of me thinking that your computer was broken after not being able to hear me, I can safely say that it was definitely a technical error on my end. So I'd ask you, if you are watching and you can hear everything, give me a thumbs up, drop me a comment to let me know where you're watching from, give me a wave, give me a thumbs up, whatever you want to do, but just give me some sign that I haven't absolutely cooked it and 2 for 2 today without sound or vision as well. So if you are watching live, thank you. If you're watching on the replay, I appreciate that also. We do obviously jump back in, answer any of the questions that you put there as well. And I will come back to everything that we talk about today. Any questions that you might have, I'll answer them live. And again, if you are watching on replay, whether that be on Facebook or YouTube, leave a comment below, share them as we're going through, and I'm happy to take them now or come back to them and answer if you have been watching through on the recording. So today's video, we're looking at further income protection changes. Now, the insurance companies have been ruthless recently with pricing changes and also some pretty drastic changes to the income protection world, and that's what we're focusing on again today. There was an announcement by APRA that was released yesterday. I'm sure you got your finger on the pulse with the world of insurance and all the changes that are happening. But the reason I do these videos is that I can share with you information quite quickly. There was a notification that went out yesterday, so fresh off the press, and there's going to be further changes coming to income protection, which will be announced as of the 1st of October 2021. Now, the reason this is so relevant is that if you're considering income protection right now and you're on the fence whether to take this out now, wait further into the future, I would say anytime short to medium term, if you're looking at income protection, this is something that's relevant to you and definitely something that you want to be looking at and making a decision on sooner rather than later. I'm going to go through what the changes themselves are, so the impact that these will have on you and what will be changing so that you know and can be equipped to look at this and make a decision as to whether or not it's relevant to you. And then also I'll walk you through, if you do have income protection at the moment, what these likely changes will mean to you as well. So if you're looking for cover or you already have it, there's going to be something in this video for you as well. If you have questions, drop them in. I'd love to get some interaction on these. It really helps me out rather than just sitting in a room talking to myself. That would be fantastic. Otherwise, I do have some stuff I'll be walking through and sharing with you today, and I am quite well versed at it, considering now is my second time. So you should be getting a better performance. We have put together the 29 common mistakes guide that I'll drop in the comments for you. If you do have any questions around that, we can actually give you that guide, have a look at it as well, because it is pretty handy in terms of the mistakes that I see a lot being made by people with their insurances, and I've listed out all of these with some context so that you can actually avoid these yourself too. I'll pop that in there now. Give me 2 seconds. Where are we? So that's in the chat there. You'll be able to see that. Yeah, Joseph, I think it's true. They should be waiting until after the lift review before making changes. I think you're spot on. And it'd be really nice if we could actually get something along those lines. The lift review, for those of you that don't know, the regulations that are coming out next year to look at what changes the government will be applying to the way that commissions are paid and the way that insurance is sold and those sorts of things. And I do think it'd be a good idea if they did wait until after that. But just because we think it's a good idea, Joseph may not see that happen. But mate, again, thank you for that comment. Firstly, the change that APRA is looking to bring in is income justification limited to 12 months. So what that means is that right now, if you've got your income protection in place, there's 2 ways to have the policy: agreed value or indemnity. Now, agreed value stopped being sold earlier this year, around April. And if you have looked at a policy since then, you've got an indemnity contract. And what that means is that an indemnity contract requires you to prove what you're earning when you claim on your insurances. An agreed value policy means that you've proved what you're earning when you applied for the policy, and you don't need to prove again at claim time. Now, the big difference is if your income has varied during those times, and that is where this big change will come through with APRA looking to limit that proof period to 12 months. So we're talking only with indemnity contracts at the moment. At the moment, there's some insurance contracts with indemnity policies that will allow you 3 years before you claim to be able to prove what your income is. Now, what that means is that they, depending on the policy again, so if you've got insurance, check with them, ask them the question around how do they allow you to prove what your income is from an indemnity purpose. The 3 years could either be the best financial year in the last 3 years, or it could be a period of 12 months within that last 3 years to be able to show what your best income period is for that time. With limiting that to 12 months, it's going to be a big difference between 3 years and 12 months, as we've seen. And right now, given COVID, we can see this happening. We can also see massive changes to income. And Joseph, you mentioned another good point there as well with women that have taken maternity leave, big one there too. So it is those people that are having variations in their income that are going to be impacted most by these policy changes. So is this a good decision? I think I can see where they're coming from, certainly. And the whole purpose of this is to try and limit those receiving benefits that are greater than what their income is. But even themselves have recognized that there's some sectors that have volatility in their income. And I do believe that the maternity leave circumstance and situation is one of those volatility opportunities that we could look at. And I think legislation by definition is hard when you're looking at black and white circumstances to take into consideration those grey areas. So I certainly think, as with most legislation, there's going to be some losers from this, and I think they're often going to be the people that need it most. I don't agree with this. I don't agree with the changes that are being made. I think there's other ways that this could be altered, and I think what has been done is a policy that's been put forward that's going to put restrictions on people that need the income protection the most from getting benefits when they need it. The second thing they're looking at doing is they're limiting the maximum benefits that you can receive from an income protection policy. So if you're unfamiliar, typical income protection policies will allow you to claim up to 75% of your pre-disability income. They're looking to limit that 75% post 6 months. And the reason they brought this in is that in many scenarios, we're seeing, particularly early days, that you'll receive more than your monthly benefit, more than you're earning by working when you're on an income protection claim. So what the government's trying to bring in here is a limitation to you receiving more benefits for not working than you were when you were working. They do recognise that there's a period early on in the claim, so the first 6 months, they'll allow you to earn up to 90% from ancillary benefits and some of they call them riders on insurance policies, but some of the extra features that are there. And they're also looking to limit the maximum monthly benefit. Now, for most of us, I don't think we're going to be too concerned by a $30,000 a month maximum income protection benefit. That would mean that your income would be somewhere north of $500,000 a year. Look, in my experience, it's a small percentage of people that we work with in this space. I don't think that's the big kicker on here, but I do see the benefit period again, the limiting of these benefits to 75% with these ancillary benefits is something that we're going to need to factor in. And again, I don't really see why they're going back on what they've already done. I understand that profitability is one issue, but I think that it's, again, as Joseph sort of mentioned, the LIF review has pushed the measures for getting new insurance in place down. So there's not as much new business going in place. Sure, there's an increase in claims. There's an increase or a reduction in the interest rates, so the earnings there. There's also the Protect Your Super benefits that have limited the amount of lower balance insurances they have. But I do believe that it's the limited volume of new business that we're seeing going in place that has also contributed to this as well. The third thing, and this is probably the one that's worrying me the most, is a limiting of the policy contract term. Now, if you've got your insurances in place at the moment, as long as you continue to pay your premiums times, you'll continue to hold that policy in place, and the insurance companies can't take that away from you. They can't make alterations to the premiums. And they can't make you stop having that policy in place that's there too, as long as you do continue to pay. Now, what they're looking to do is put a policy contract term in place of 5 years, which will mean that every 5 years you'll have the right to enter into a new contract. And I think that's a funny way of putting it, considering you're the customer. You've got a right to re-policy as a customer. Now, what this means is that without doing a medical review, so you won't have to go through that full underwriting process, you'll have the opportunity to reapply for the cover. And you'll have to update your occupation, your financial circumstances, and any dangerous pastimes you're doing. Now, the reason this concerns me is that insurance works well in a black and white situation. It's either yes or no. And what I believe that this thing or this condition is doing is providing a bit of grey. Now, just depending on what you change, I think some of these variables are pretty open for interpretation. Like, what's a dangerous pastime, for example? Who defines that? Why does it change? Are there a certain list? And there are, but that can change based on what's happening in the world. Now, my concern is, and we've seen the insurance companies move to be a little bit more conservative around COVID time. So they've certainly been a bit more conservative with applications. They're looking at different measures to limit certain industries and those sorts of things now. Would they have a similar scope? Would there be conditions in these policies with these contracts that are renewable that would limit their ability to offer these contracts for certain people again? And I just don't like the way that this is heading. And I certainly would hate to be in a position that you've paid for the cover when you've done the right thing. You've taken out insurance in the first place. You've paid for it for the 5 years. And for whatever reason, the insurance company decides that your industry, your occupation, your pastimes don't fit the brief of what they're looking to do, and they won't offer you that contract anymore. So I don't like the idea of these, wiggle room for the insurance companies. And I think all it leads to is disappointment as a customer. And I've said this to a number of people recently. We talk so much about profitability and we talk so much about sustainability of the industry, but we've forgotten about customers. And I deal every day with people like you, the customer. And I think that's what we need to focus on. And if that's the way that we focus and that's the motivation for us making these changes, some of these things wouldn't come to fruition, and they've gone too far away from looking after you as the customer and the policyholder, and that's what concerns me a bit with these two. So finally, number 4, they're looking to, I guess, put a caveat on long-term benefit periods. So the insurance companies are looking at benefit periods through to the age of 65 or 70, and whether or not these are at, I guess, loggerheads or at conflict with people going back to work. Now, I'm just going to share with you my screen for a sec, and I'll just explain, in case you've forgotten, how the terminology or what the benefit period actually means. So if you're looking at an income protection policy, the first key terminology that you'll see is the waiting period. Now, that's how long you need to be off work before you start to get paid from the insurance company. And the second one that we're talking about now is the benefit period. And the benefit period is how long you will be paid the benefits from the insurance company if you can continue to be unable to work. Now, the benefit period, if you have your policy with an industry fund or through your super fund or even through a retail policy, you may see benefits you may see a policy with a 2-year benefit rather. Other policies that you'll see will have benefits paid through to age 65 or age 70. Now, these are the policies that they're talking about here, and the limitations on these longer term benefits are the ones that they're concerned about people getting back to work. Now, having done a lot of these income protection claims, and as a matter of fact, we've got, as a matter of fact, we've got 4 income protection claims on the go at the moment, all of which have benefits to age 65. I have never worked with anybody who's received an income protection benefit that didn't want to get back to work. And what I mean by that is that the people that I work with, and most of the people that are out there, aren't interested in simply receiving benefits from the insurance company and not being able to get back. They want to get better. They want to get back to work at some point, but they're just not able to in the same capacity that they were previously. And this is where I really see a big issue here, is that they're not even talking about partial payments. So the way that works, and again, it's probably easier if I draw it. income protection isn't an all or nothing style policy. So it doesn't mean that you can either receive full benefit or no benefits. So they're not the only two options. Let's say, for example, that as you get better, you have an ability to go back to work in some capacity, which means that your income from work starts to go up a bit. So you start receiving income. What the income protection policy will do, they'll actually reduce the monthly benefits that paid from the insurance company, and they'll top up that amount in addition to what you earn from working to provide you with that full benefit rather than having to pay the full thing from insurance. So most people that are on an income protection claim, in my experience, have gone through some form of rehabilitation. They come to work, whether that be 1 day a week to start with, 2 days, 3 days, 4 days, 5 days, until they get back to that full capacity. And therefore, the amount that they're receiving from the insurance company reduces over time. So I don't really see where they're going with this in terms of protecting long-term benefits, because my experience, as I mentioned, has been that anyone who's on claim wants to get back. They don't want to be off work. So I really, again, don't see where they're going with this. So they're the 4 major changes that these guys are looking to do. It was dropped on everybody 30th of September, and there was a bit of misreporting that it was going to be in effect from the 1st of October 2020. Essentially, it's the 1st of October 2021. So we do have 12 months to look at this stuff. So it does give us a fair bit of time and warning to be prepared for this. So my suggestion to you is, if you are on the fence with getting some income protection, if it's something you're looking at, or you know you need to look at this in the short to medium term, so the next 12 to 36 months, I'd strongly suggest that you take the time to research this a little bit further. So understand what these changes are and what it means to you. If you've got income protection in place at the moment, revisit this for yourself right now, because if you do look to revisit your insurances beyond the 1st of October next year and you're not happy with what's in place, you're again going to have a limited choice as to what you can move to. And we're finding a little bit about that at the moment. The insurance companies, as I mentioned in a couple of my earlier videos, have put up their prices recently. And there's some of these features, the agreed value, level premiums, those sorts of things that would be lost if you moved. And therefore, I've found that people are better off staying where they are. The downside to that is that you feel like you've been painted or backed into a corner. So if you are in a position that you've got the policy at the moment and you aren't sure whether or not it still suits you, check into it now while you've got a bit more choice than you will in 12 months' time. Certainly, you do have a reduced choice to what you did 12 months ago as well, but now is a good time to be looking at this again. If you do have any questions, shoot them through. You'll find the link to the 29 mistakes. There's a couple of things on there about income protection that I'll mention. Grab that one and have a look. Joseph, I appreciate you tuning in. Thank you for your comments as well. It sounds like you've got a pretty good handle on this stuff as well, and we tend to agree on a lot of this stuff. So I do appreciate the feedback that you've got in your position on this. And yeah, we'll be back again same time next week, going live closer to 1 o'clock, because I will not record 2 of them, one without sound. Thanks again for tuning in. Appreciate it, and see you next week.